The endgame Schiff has been warning about Zoom out far enough, and the picture becomes impossible to ignore. What is unfolding is not a temporary scare, not a passing cycle, and not a story limited to one asset or one market. This is a structural shift in how value itself is being measured, stored, and protected. Precious metals are not the cause of this shift, they are the signal. For decades, the world optimized for convenience, speed, and cheap money. Growth was pulled forward from the future and spent in the present. Debt replaced savings, leverage replaced discipline, and confidence replaced caution. As long as capital was easy and consequences were delayed, the system appeared stable. But stability built on delay is not stability at all. It is fragility disguised as strength. Now, that disguise is wearing thin. Across global markets, real assets are waking up. Not because of speculation, but because reality is reasserting itself. Years of underinvestment have collided with rising demand, and the result is pressure everywhere. Mining was neglected. Energy development was postponed. Infrastructure was deferred. Everyone assumed supply would always be there when needed. That assumption is proving dangerously wrong. This is how long commodity cycles turn into super cycles. Not overnight, and not with fireworks at the beginning, but with quiet constraints that slowly tighten until something snaps. When supply cannot respond quickly, prices do not adjust gently. They lurch, they overshoot. They punish those who waited for balance. But the deeper story goes beyond commodities. It goes beyond gold and silver themselves. It goes to the heart of the monetary system. Currencies are supposed to be measures of value. They are supposed to be stable references that allow people to plan, save, and invest with confidence. When that confidence erodes, the entire system begins to distort. Prices rise not because things become more valuable, but because the measuring stick becomes weaker. This is the uncomfortable truth most people still refuse to face. When everything appears to be going up at once, it is rarely a sign of universal prosperity. More often, it is a sign of currency debasement. Stock markets celebrate record levels. Indexes hit milestones. Headlines cheer growth and resilience. But measure those same assets in something real, something that cannot be created by policy decision, and a very different picture emerges. Purchasing power tells a story that nominal numbers hide. Gold exposes that story mercilessly. It does not lie. It does not spin. It does not care about political narratives or optimistic forecasts. It simply reflects the erosion of trust in paper promises. Every new high is not a celebration of gold itself, but an indictment of the currency measuring it. Silver amplifies that message. Where gold moves with authority, silver moves with urgency. It is both a monetary metal and an industrial necessity, which places it at the center of this transition. When monetary confidence weakens and industrial demand remains strong, silver becomes a pressure point. And pressure points are where systems break. This is why the current moment feels different. It is not just another cycle of fear and relief. It is a convergence. Monetary stress, supply constraints, geopolitical friction, and institutional repositioning are all happening at the same time. These forces do not cancel each other out. They compound. Central banks understand this, even if they do not say it publicly. Their actions speak louder than any statement. They are not behaving like institutions confident in the long-term stability of fiat systems. They are diversifying. They are hedging. They are accumulating assets that exist outside the web of counterparty risk. This is not ideological. It is practical. Every unit of gold removed from the open market is a unit that cannot be used to satisfy future demand. Every ounce moved into long-term storage tightens availability further. This creates a feedback loop. Rising prices attract attention. Attention attracts demand. Demand collides with limited supply, and the cycle accelerates. Silver faces an even harsher reality. Unlike gold, much of the silver mined is consumed. It disappears into industrial processes and does not return to the market in usable form. At the same time, investment demand is awakening from a long period of neglect. This creates a structural imbalance that cannot be solved quickly, regardless of price. This is why waiting feels safe, but is not. The instinct to delay, to demand perfect clarity before acting, is understandable, but markets do not reward emotional comfort. They reward preparation. Peter Schiff has been warning about this endgame for years, not because he enjoys pessimism, but because he understands arithmetic. Debt cannot grow faster than productive capacity forever. Currency cannot be diluted endlessly without consequence. Trust cannot be abused indefinitely without breaking. When past crises were delayed, they were not resolved. They were compounded. Each intervention postponed pain at the cost of making the eventual adjustment larger and more violent. What was once manageable became systemic. What was once contained became global. This is why the current reset will not look like previous ones. The starting point is worse, the margin for error is smaller, and the tools available are fewer. Policy responses that once felt extraordinary are now routine. Liquidity creation has become expected. Support has become permanent. Markets no longer fear intervention, they depend on it. That dependence is a sign of weakness, not strength. When confidence finally breaks, it will not break slowly, it will break all at once. And when it does, people will ask the same questions they always do after the fact. Why didn't anyone warn us? Why didn't we see this coming? Why didn't we act sooner? The truth is, the warnings were there. They were simply inconvenient. Schiff's message has never been about timing the exact top or bottom. It has been about positioning for inevitability, about understanding that systems built on illusion eventually confront reality, and that reality does not negotiate. This is not about abandoning markets or retreating from progress. It is about recognizing that real wealth is measured in resilience, not nominal gains, that protection matters as much as growth, and that ownership of tangible assets is not an anachronism, but a form of insurance against systemic failure. The endgame, he describes, is not cinematic collapse overnight. It is something more subtle and more dangerous. A slow erosion of purchasing power, a quiet loss of confidence, a gradual realization that the rules people relied on no longer apply. In that environment, those who prepared early are not panicking. They are adjusting. They are not scrambling for protection at inflated costs. They already have it. They are not forced into bad decisions under pressure. They have options. Those who waited, on the other hand, are left reacting, paying higher prices, accepting worse terms, and wondering how patience turned into vulnerability. This is why Schiff keeps repeating the same advice, even when it sounds repetitive. Because repetition is sometimes the only way to break through denial. Because the crowd never believes the warning until after the damage is done. The shift underway is not ending, it is accelerating, and it will not wait for consensus. The question is not whether the system will change, it already is. The question is whether you recognize the endgame before it forces you to. Those who understand what is happening beneath the surface are not celebrating headlines or fearing volatility. They are positioning for durability, for survival, for a world where trust in paper promises is no longer enough. This is not about fear, it is about clarity. And clarity, once gained, changes everything. There are two silver markets, and confusing them is one of the most expensive mistakes an investor can make. One exists on screens, the other exists in the real world. Paper silver trades endlessly, contracts change hands, numbers move. Positions are opened and closed without a single ounce ever changing location. This market is liquid, fast, and comforting. Physical silver is the opposite. It must be mined, refined, minted, transported, stored, and once it is gone, it does not magically reappear because demand increased. This is where the danger lies. When prices rise slowly, supply chains cope. When prices rise violently while supply shrinks, premiums explode. Not gradually, instantly. This is what Schiff is warning about. If you are trading paper, you can argue about timing. If you are buying physical, timing argues with you. The real risk is not buying too high. The real risk is waiting until the metal is no longer available on reasonable terms. Once shortages become mainstream news, the metal is already gone. What remains is waiting lists, delayed delivery, and prices that no longer resemble what you expected to pay. And the cruel irony is this: you can be right on price and still lose. You can wait patiently for a pullback, feel disciplined, feel smart, and still end up paying more because premiums widened faster than prices fell. That is the trap forming right now. This is why Schiff keeps repeating one uncomfortable truth. Availability matters more than perfection. Because once fear replaces complacency, the scramble is never orderly. Industrial demand does not pause for investor comfort. Export restrictions do not wait for technical indicators. And when global supply lines tighten, physical metal becomes a scarce asset overnight. Most people are psychologically unprepared for this. They assume there will always be time, always be supply, always be an option. History says otherwise. When everyone decides they want the same tangible asset at the same time, the market does not negotiate. It rations. And that rationing does not care how long you waited or how disciplined you felt. Peter Schiff has been watching markets long enough to know when something is noise and when something is a signal. Most people never learn the difference. They react to headlines, chase trends, and mistake confidence for safety. Schiff watches something else entirely: structure, incentives, and stress points inside the system. What he is warning about now is not a prediction. It is an observation in real time. This moment feels calm to many people because chaos has not yet arrived on the surface. But beneath that calm, pressure is building. The kind of pressure that does not release gradually, the kind that snaps. The precious metals market is no longer being driven by speculation alone. It is being driven by necessity, by protection, by survival instincts from institutions that understand how fragile the system has become. Confidence in paper money is eroding quietly, not in speeches, but in actions. Central banks are not debating, they are acting. They are repositioning away from promises and toward permanence. When the institutions that create currency start hedging against their own product, that is not coincidence, that is confession. And yet most investors are still waiting for confirmation, waiting for validation, waiting for permission. But markets do not wait for comfort. When monetary policy becomes trapped, when easing becomes unavoidable, the consequences are not theoretical. Purchasing power leaks away invisibly at first, then suddenly, then all at once. History shows this clearly. When real returns disappear, capital flees toward assets that cannot be printed, diluted, or redefined. Gold does not need faith. Silver does not need belief. They simply exist. This is why the move in metals has not been polite. It has been aggressive, sharp, disruptive. And those sudden gaps that seem to appear out of nowhere are not accidents. They are institutional moves happening before retail investors even realize the door is closing. Liquidity does not announce itself. It arrives early, moves fast, and leaves others staring at charts, wondering what just happened. This is why Schiff keeps emphasizing timing. Not because he wants people to rush blindly, but because he understands that once confidence breaks, markets reprice brutally. And this time, the foundation is weaker than it has ever been. Debt levels are higher, distortions are deeper, and the tools used to delay past crises have already been exhausted. There is no clean exit from this situation. Only trade-offs. And every trade-off involves sacrificing purchasing power. Gold absorbs that sacrifice. Silver magnifies it. This is why silver in particular is becoming uncomfortable. It is volatile, yes, but volatility cuts both ways. When supply tightens and demand wakes up simultaneously, price becomes secondary. Availability becomes everything. This is the part most investors are still blind to. Something is unfolding right now, quietly but relentlessly. It is not flashing across breaking news banners. It is not trending on social media. And because of that, most people are completely asleep to it. While headlines argue endlessly about optimism, recovery, and future promises, a much deeper shift is already moving beneath the surface. A shift that does not wait for permission. A shift that does not announce itself politely. A shift that has destroyed wealth many times before while the majority looked the other way. If you already hold gold or silver, you can feel it. If you have been waiting for the right moment, this is the moment that separates patience from regret. Because there are moments in history when hesitation does not protect you. It quietly punishes you. What we are witnessing now is not a theory. It is not speculation. It is not an exaggerated headline designed to scare clicks. It is urgency. And that urgency is coming from someone who has seen this movie before. Peter Schiff is not shouting for attention. He is not guessing. He is recognizing patterns that most people refuse to acknowledge until it is too late. His warning is uncomfortable because it demands action before confirmation. And most people are wired to wait for confirmation, even when waiting is the most expensive choice they can make. His message is simple, but it cuts deep. Do not wait. Do not wait for reassurance. Do not wait for approval from the crowd. Because by the time the crowd feels safe, the opportunity will already be gone. On the surface, the movement in precious metals looks like just another phase in a long trend. Strong, yes. Impressive, maybe. But familiar. That is the illusion. The real story has nothing to do with charts, candles, or technical debates. The real story is happening behind the price. It is happening in supply chains. It is happening in vaults. It is happening in silence. Physical availability is tightening, quietly, relentlessly. Inventories are thinning. Restrictions are appearing where there used to be flow. And the part most investors ignore until panic sets in is beginning to strain. Premiums, the hidden cost that only reveals itself when it is already too late. You can stare at spot prices all day. You can debate perfect entry points. But if physical metal becomes scarce, the price on the screen stops mattering. What matters is whether you can get your hands on it at all, and what you're forced to pay when everyone else realizes the same thing at once. This is where past experience becomes a liability, because what worked before will not save you now. Waiting for pullbacks has conditioned investors to believe patience is always rewarded. But in environments like this, patience can quietly turn into a trap. Even if prices pause or dip, premiums can surge so violently that you end up paying more than if you had acted earlier. That is the danger most people do not see coming. So the real question is not whether gold and silver are moving. That much is obvious. The real question is this: what does Peter Schiff see that Wall Street still refuses to acknowledge? Welcome to a space where hype is ignored and reality is not sugarcoated, where signals matter more than slogans, where the focus is not on chasing gains, but on protecting what you have already spent your life building. This is not about getting rich quickly. It is about not getting poor slowly. And this shift is not local. It is not regional. It is global. What is unfolding does not respect borders, currencies, or political talking points. It moves through the financial system like pressure building along a fault line. Silent at first, then sudden, then irreversible. Peter Schiff has lived through cycles where everything looked fine right up until it wasn't. He has watched confidence evaporate, narratives collapse, and entire asset classes reprice faster than people could react. And what he is seeing now is not something coming in the distant future. It is already happening. The precious metals bull market is not approaching. It has arrived. And it is being driven by forces that do not reverse gently, forces that require painful resets to stop, forces that punish denial and reward preparation. Confidence in paper promises is eroding. Inflation is no longer temporary, and monetary authorities are cornered by their own decisions. When easing becomes unavoidable, when real returns disappear, and when trust in currency weakens, history shows the response is never slow or polite. It is violent, it is fast, and it leaves latecomers scrambling. This is why timing suddenly matters again. Not in months, not eventually. Now, when global liquidity shifts, it does not move in neat steps. It gaps. It jumps. It revalues assets in ways that leave no rewind button. By the time most investors are paying attention, the move has already happened without them. This is not fear. It is pattern recognition. Every major cycle like this follows the same script. First, disbelief, then dismissal, then regret, and finally panic. Those who wait for confirmation always end up buying at higher levels, with worse terms and fewer options. Those who act early rarely feel comfortable, but they sleep better later. That is why Schiff keeps repeating the same advice, not because it is dramatic, but because repetition is sometimes the only way to break through denial. Do not wait for the crowd. Beat the crowd. And the people who listened early are no longer asking whether prices are too high. They are asking how much higher this can go. This is only the beginning.